All right, traders, good afternoon. This is Christian from Tribeca Trade Group, and it is Thursday, March 18th. Video coming at you a little bit later than usual. I had to take a call after the close. So let's get into today's price action. Ugly. Just to summarize what you have on the left of your screen, SPY was down 1.4%. Qs again took the brunt of the damage, down 3% for the day. Small caps also down 3%. So even Steven there with Qs and IWM for the two stinkers of the day. And then you have this big green bar coming across here, which is for the VIX. VIX ramped up a bit today, back up to about 21, 22. Kind of interesting because we're not as high as where we were, a couple of weeks back when we had the last bout of volatility. That was stretching up to about 29.30. We'll review those VIX charts in a second for conclusions. Let's talk a little bit about just what we've experienced here in the last day or so, post-Fed meeting. Fed meetings, they're always kind of tricky. It's the best thing I can kind of describe it. I think overall, and before I kind of go into what I'm about to say, risk disclaimer in front of you, everything that we're going through is for information purposes only, not giving out any advice, recommendations, or anything like that. But what my observation always around these Fed meetings is sometimes you do see a change of direction. Usually we get that the same day. Sometimes it's the day after, or the overnight session when things have a chance to kind of settle in terms of what the Fed stance is going to be. Now, I would say above all, and a couple of things that I said on Twitter earlier today was, one of the things that we've heard for a while is, don't fight the Fed. And make sure you're on the right side of the Fed, whether they're expanding or whether they're contracting the balance sheet, right? That's a big thing. But also don't don't go against the underlying trend of the market. And I do believe that above all else, right? The Fed, fundamentals, a bunch of other things, valuations, right? Price is still the number one factor for me. I am a trend trader. I follow the trend. Price is going to reward me. Price is going to hurt me, right? And so I never argue with price. If you've been a viewer of my videos for a while, I try to stay as disciplined as possible in terms of what I've got on my screens. The indicators on my screens give me a heads up in terms of if something is trending up, if something is range bound, or if something is beginning to kind of break down or in a downtrend, right? For when we start to kind of move into downtrends, I want to dial down my risk. I want to have little to no exposure if we start to kind of move into a downtrend. So, for example, and it's just easy. I'm not comparing what we're going through now to back what we saw last year. But once we start to break below, my exposure got less and less, right? I think I had tried some things back in here. We didn't really do much of anything and we kind of fell apart. So when this was happening to me last year, right, I had virtually no exposure, right? Because we were trending down, and it's not a place for me to really to guess how much further we're going to go down. One of the things that helped me along the way is to know, when price is below all the moving averages, I don't want to be long much, right? I don't care about when things are going to reverse. I don't care about making predictions about when things are going to reverse. I'm going to trust the price action to tell me that. Right? And again, confirmation is a big thing. Once we started to see things act better and stocks were acting better rather than the overall indices, I did start to take on risk in that situation, right? But what kept me out of a lot of trouble is realizing not to get in front of god-awful bad price action, right? So if we fast forward to what we're seeing now, right? So obviously we don't have that situation the same situation on our hands, but we did lose this uptrend of what we've been kind of this nice move that we saw the last couple of weeks. We're now trending a little bit into value. So ideally, what I want to see is for us to stay above value and stay continuing to trend higher, right? That's just by definition using the MarketWebs indicator is telling you how we're trending, whether it's uptrend, whether it's range bound, which you could see on the left of your screen, or whether we're in a downtrend. So that's the S&P. Doesn't really look that bad other than breaking into value for the month. If you want to look at this on a shorter time frame, we've also broken into value for the week, right? So to me, that says to exercise some caution, right? Until, and we don't know, obviously, as we were kind of moving around today, and towards the end of yesterday, you're going to get faked out and things. I got, completely faked out at the close yesterday. I thought, hey, we got a nice reversal bar in the Qs, and that could be a retake of the 50-day moving average, and the Qs could start pushing higher. That didn't happen, and what I do is just I continuously reassess, right, as price action is changing, right, and I want to stick to being very disciplined, right. I had this tweet that I put out earlier, and I said, hey, I made a mistake yesterday. I put on some cues, and obviously in the overnight session things developed and they kind of turned, right. So I said, one of the sayings that I always come back to in trading is it's okay to be wrong. We're going to be wrong from time to time. I like to be right all the time, but I know that it's just not it's not possible to be right all the time. When I'm wrong, one of the major things for me to do is not to stay wrong and not be stubborn. I found this particularly funny because this is what I expressed on Twitter. And then people proceeded to ask me if I was going to buy the dip and if I was going to stay in the trade. And I had just written literally in the tweet before that I'm not going to stay wrong. So it's funny that people, I guess don't understand, everything that comes out in a tweet or what that expression means. But it means if you're wrong, get out of the trade and start over, start from scratch. Or if you're wearing that risk and you're comfortable with it, don't add to it, which is the kind of the situation that I found myself in. But bottom line, before we go over to the Qs analysis, which is going to be different, this 39.19 level is an area that I want to see us retake. If we don't, and if we stay down here on the 1 hour chart and in here in the daily chart, what does that mean? It means, well, there's going to be less really good looking setups because this is the S&P 500. It's going to be a place for me to be more cautious. And that's basically it. Right here, I want to be more aggressive. Down here, when we're moving around and kind of in no man's land, I want to make sure I'm more defensive, right, and more conservative with risk taking, right. So this is just basic trading and how you manage trading. The Qs. Now, this is a different picture, right? So, this we could kind of rely a little bit further back on what we experienced back here. You notice that it's kind of a similar thing that happened. And again, I'm not making any conclusions. I'm just trying to give you an example of what we kind of experienced. Last similar time of the year is about the only thing that's similar here is that we broke below the 50-day moving average. We caught support at the 200. We bounced, and then notice that we failed going back into the bottom of value. Right? Now look at what's happened here. We've done basically a very similar thing here, is that we've broken below, we've come back and we've retested, and we've failed. So does it mean that we go all the way down here? Well, we don't know that yet, right? And I hate when people on Twitter and so forth think that they know, because really, nobody knows. Nobody knows if we're going to go all the way down here, or if we're just going to kind of sit here and then go higher, right? Or another outcome is we do like a double bottom and come down here and then do like a W pattern, right? So there's a bunch of different outcomes that can happen here. Nobody knows any of them. I could set you up, fancy looking pictures and draw trend lines and say, go like this and like this, like this and then like this. And I see people do this. They're like Picasso with these charts, right? And say, oh, well, maybe we'll just come down here, right? And then we'll do this, right? And then, and then we'll do this, So I could say, oh, that's what we're going to do. But in reality, we don't know that's going to happen. Or I could extend the line further and do like a W. What I do know for 100% certainty in my trading program, once we do something like this and we fail to stay in value and we get rejected at the 50-day moving average, what my trading system says, especially like in this area of the Qs and in growth, is to be defensive. Right, until we figure out what the hell is going to happen from here, because this is an ugly day. And I hope, right, now there's a difference between trading plan and having hope, but I do hope that we go back into here. But I'm not going to use hope in my trading, decisions and judgment. So that's kind of what we're faced with right now. And I think instead of saying, oh, I want to buy the dip, right? I'm not like that. I would rather wait for a little bit of confirmation, at least to see us, it won't take us much to get back into value, right? And if this is a strong market, then that'll happen. If not, I'm not going to start adding here if we're going to drop down here, right? And we just don't know that. And again, I hope that's not the case, but I'm not going to position that way because I really don't know. And there's too many things. We do have to realize that tech has gotten a very crowded place. We don't know how much unwinding is going to happen. We have quadruple witching tomorrow, which could be behind some of the moves, as well as the Fed. The Fed's, that happened yesterday. So this is a turbulent week. So let's hope that this is just a matter of time of getting through it, right? And also this period mid March to the end of March is a weaker seasonal period. April's a bit stronger. So you got to have your money available for when the market does, when we're in a more favorable investing climate, right? So now, again, a couple points here is if you get a couple things wrong, it's okay. Everybody gets things wrong, right? Not very many people admit it, especially on Twitter. You're not going to find that. But you really have to decide for yourself what your level of risk is. And if we do come down to here, right, you want to try to map out all outcomes, as much as possible, so that if we do start to come down here, and even if it's making, a higher low in here, which would also be a good outcome as I have drawn, you still have to be okay with, if you bought calls here, it's going to be harder for them to work if we continue to go down here, right? So I'll kind of turn this around to some of the things that I think is important to kind of learn from when we're doing these things and when we do lose the short-term trend as we have done here, right? So let's talk a little bit about sector performance and then I'll get to some of those best practices before we kind of before we end the video, and then of course I'll talk about today's trades and how I traded things for the day. But yeah, you could see the other thing that happened today was not just the move in interest rates, right, which has been one of the catalysts. I don't want to say that the move in interest rates is the whole catalyst for what we've been seeing in the Qs, because it's also the fact that tech and growth got extremely overcrowded because of the coronavirus situation, right? So you do have multiple factors, not just one, not just bonds, in my opinion. So that's the other part of this situation. Now, the market did not react very well to what France said today. France is apparently going into another lockdown, and you could see what happened to crude. So crude is, the more people stay in their homes and don't do things, don't travel and so forth, this is what happens, right? You could see a decent move back and move down in crude. Now, I understand that there were some other things going on with, I believe, OPEC or something like that. But I think part of this market selling off today was the fact that France is experiencing a possible third wave, which is really not what anybody wants to hear. So you got a lot of things going on. So if we look at the worst performers, believe it or not, it was not tech, it was energy. It was also higher beta things like, solar and clean energy and things like that, pot stocks as well. Just higher beta. Growth was down 2.6% versus value was only down 40 basis points. So for now, this is still going on, right? This value to growth relationship. And again, if we look at this, which I've shown a few times here, large cap value versus growth, we could still, I think, retrace, somewhere into this region. So I don't think that this unwind of growth is done yet, in my opinion. But that's just my opinion. So I mentioned I would talk about a couple things that I traded today, which I always do. I was off to a pretty good, midday. I was, feeling pretty good. I had made some good decisions, I thought. I got some profits in Boeing. I had to take the last piece of Boeing off for a little bit of a loss, but I got lucky with some short-term calls in Boeing. But I really like what's going on in Honeywell, and things that are just holding up so much better, right? So the industrials continue to be strong. Now they did not close on the highs, and you could see I did unwind this trade, which I wanted it to be a swing trade, but I have to respect price. Right, so I took a target and even small targets on this because I think right now this environment is more or less like hitting base hits and doubles, not hitting, not going for triples and home runs right now. So, I got out of this and I salvaged, I didn't lose any money on this particular trade, but there's a couple other things that did not fare as well. Blackrock was, I think, a fine setup middle of the day, but, take a look here. It did not do what I was looking at to do in terms of a trading signal. It did not close above value, which is 729, because again, I'm looking for this thing to start trending out of the range that it's in. If it goes back in the range, if it's a technical signal which I'm trading, which I am, I get rid of the trade. So even though this thing I think still has a chance, tomorrow it could get right back above value. That's fine. I'll re-engage the trade, but I'm not going to stay in a trade that has lost the whole reason for being in the trade. Do you see the difference, right, of trading disciplined and knowing, planning out your trade and knowing how it's going to work versus where it's not going to work? I wish I took the stop a little bit sooner. I did wait until a little bit too long, but that's the problem when with using kind of intraday stops and so forth. I don't use hard stops. I use soft stops, obviously. Another name, too, that looked pretty good was the whole steel group, right? And steel, U.S. Steel still finished up positive for the day. So I think if the volatility settles down a little bit, you're going to find these things go where they were naturally going to go to for the day, which I think is higher. I think the steel group looks very good. Cliffs Resource I also jumped into, and this did hold the top of value. It broke into, it did not hold the top of value here, but I gave myself a little bit of tolerance for this one. So I'm still on that one. I did take some profits in U.S. Steel, but again, I'm going to where I see strength in the market, right? I think what you'll find is some of the names that I'm trading are much different than what you see a lot of other traders on Twitter talking about. It's this, you have to continue to kind of, what's the expression? Skate to where the puck is going to be, not where it's at. And I see a ton of people still putting out names that they think are just going to come back, in growth. And I think those right now are in distribution phase, and you got to give them time to heal a little bit and wait until those buyers to come back in. To use another expression, you don't want to be the first one in. You want to wait for the institutions to start supporting some of these stocks, right? Regardless of what an individual player is doing, right? We know Kathy Wood and ARK Investments is buying some names, but the overall street institutions are still getting out of some growth and going into value. And I think it doesn't take a lot of conclusion. It doesn't take a leap of faith conclusion to understand that. When you look at some of these names, like a U.S. Steel, Cliffs Resources, the industrials, the materials, the financials, they are holding up so much better than the growth names because people are still selling the growth. The institutions are still selling the growth names and moving into value. So that's the situation right now. So I think taking a deep breath right now and realizing that you can't control the market, you can't buy and move the market, regardless of how many people try to do it on Twitter, which is a bunch of BS, thinking that they're going to take their 100,000 followers plus and tell everybody to jump in a stock. They jump in it, and then that person sells. Right? That's the scheme that goes on with people who have a lot of followers on Twitter. If you're not aware of that, take a look at what happens to a lot of these people who do that. So be aware. So if somebody's giving you their picks and giving you their chart setups on Twitter, just keep it with a grain of salt that a lot of times what they're going to do is they're going to get into the position first, and then they're going to pump it as much as they can. Pump it, pump it, pump it. Like when you see somebody tweet out a symbol or 5 times, right? They are trying to bring a small cap stock up so that they can sell it and then they leave everybody else with it. So be mindful of this kind of stuff. I would also say, I encourage independent thinking and analysis, right? We see a lot of things during a given day. I read a tape all day long, right? I'm watching option activity. You have to incorporate those types of things, or the ARK fund, to see what they bought and sold every day. Just because they bought something, or just because there's a call buyer on the tape, put it into your system and figure out if it's a good place. Another thing that I see, which I think is troubling on the tape, is this need for immediate gratification, right? That's the whole Reddit movement, right? They have to have profits quick, right? A lot of what trading is being patient. When the tape is not in a good place, writing things down, believe it or not, trading less is what you want to be doing. In my opinion, right? Everything is my opinion here. This is for education only. But writing things down, so if you see a call buyer in Cliffs Resources, or in Tech Resources, or an Owen Semiconductor, a couple things that we've seen the last couple of days, legging into a position makes sense to me, or just waiting. Putting that down in your notes and saying, okay, where is a good entry point for me? Right? Not following something because somebody's mentioning something on TV. Unless you're just in it for like a 10-cent scalp, right? So if that's what you're doing, you could do that to your heart's content. But really, I'm looking for bigger moves than, somebody pumping something on TV, and then, getting 15 cents out of it and getting out of it. Now, I do those trades too, but that's not the bulk of what I do. All right, guys. So bottom line is, I mentioned that I would go over a couple best practices. When we're in a distribution phase like this, right, and when we're struggling to get, to kind of find the trend, to get above, things like the 50-day moving average. Number one, keep position. I mean, these are basic things, and I've been saying them now for a couple weeks. Keep your positions light. Keep the number of positions less than normal, and try to avoid short-term options. Short-term options are not just weekly options. They're options that expire less than 60 days. So April right now is a short-term option, right? April maturity. The more that you put on risk that is short-term in that nature, the bigger hole that you're going to have to dig yourself out of if the market doesn't go in your direction. Okay, so be careful of that. And be mindful too. Some people are very quick with options. They're in and out of them within like 15 minutes, 20 minutes, right? If you're sitting with some of those options that are short term, and you don't get a fast aggressive move that you're looking for, you're going to dig yourself a hole that is going to be very difficult to get out of. So that's the main goal, right? When we start to see things like this, where we're getting rejected here, the idea is to not press, is to kind of back off and let this situation work itself out. All right, guys, that's it for today's video. Have a great night. See you tomorrow.